And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Jay Gragnani, Head of Research and Client Engagement at Nasdaq Dorsey Wright. Jay, thank you very much for coming on the show.
Adam, it's great to be here.
So Joe, I always like to begin by asking, can you tell us your story and how you got involved in the business?
Sure. I was really started in the business at Nasdaq Dorsey Wright and started as an intern. Prior to that, in terms of just the interest in the financial markets, I mean, that goes back many, many years. And really, it was my dad who piqued my interest in the financial business to begin with. And I remember as a kid coming, when he would come home from work and turning on some of the TV shows to watch, watch the market, see what happened over the course of that day. I mean, obviously, you didn't have the 24/7 media coverage that you have today. And so that was how he got his information, is after he got home at night and watching. And it's not that he was in the financial business. He actually worked virtually his entire career, not in the financial business, but it was just, watching the markets and seeing what was going on. And that was really what piqued my interest in the financial business. That ultimately led to studying finance in college at Virginia Commonwealth University, is where I graduated with a degree in finance. And during that time, while I was studying there, I was introduced to Dorsey Wright as a company. And Dorsey Wright as a firm was founded in Richmond, Virginia back in 1987 by Tom Dorsey and Watson Wright, and always had a very, very strong internship program. And so I was actually introduced to Tammy DeRozier at the time, who Tammy was a longtime friend of someone, my girlfriend at the time, my now wife, was a very, very close friend to her uncle. And we were at a family function one day, and he said, "You're studying finance. You need to talk to my friend. Her name is Tammy. I don't know exactly what she does, but I know she's in finance, and I know they're always looking for interns." And I said, "Absolutely." So next day, got on the phone, called up, and ended up getting an internship with Dorsey Wright. And that was in 2005, graduated in 2005, and I started working for Dorsey Wright full-time back in 2005. So about 15 years now since starting in the business. Personally,
Oh, wow.
and that's, so I've spent my entire career with what started, it was Dorsey Wright and Associates. Dorsey Wright and Associates was started in 1987, like I said, by Tom and Watson, who were stockbrokers in the business, and started Dorsey Wright. About 5 years ago, we were acquired by Nasdaq. And so now we've been part of the Nasdaq family for about the past 5 years.
Nice. So that's a great way of getting involved in the business, and friends of friends, and just happen to be in the right place at the right time. So I guess my question is, again, with the childhood interest, that's really, really intriguing on my end. When you were younger and you wanted to be in finance, did you have a particular leaning in fundamental analysis, technical analysis, or going any direction, or you just knew you wanted to get in, like the game was cool and you wanted in? Or was there any kind of earlier? Yeah.
At the time, I didn't know what fundamental analysis or technical analysis was. I didn't understand that, as a kid. And then
Right.
As you get into school and you get into university and studying it, the only thing that they taught was fundamental analysis. We never
Right.
had classes in technical analysis in school. And so,
Right.
it was really, really eye-opening when I went to work for, internship. And one of the things that I was part of the duties as an intern at Dorsey Wright was to chart stocks by hand. And so
Wow.
we used point and figure charting. And so that was the initial, my initial foray into technical analysis. But also, I was on the front lines of answering phones, and throughout the course of the day, our clients, which are financial advisors, those are primarily our client base. They're calling in, talking to the analyst team in Richmond, Virginia all day long. And, I was talking to them, helping direct some of those phone calls. But it was incredibly eye-opening very early on that here is this company, Dorsey Wright and Associates, that focuses 100% on technical analysis. And there are thousands of advisors who are utilizing technical analysis in the real world, in their actual practice, to manage client portfolios. Yet it was never taught to us in the university. And so it was a very, very interesting dynamic of, seeing real world application of technical analysis and how, how useful it has been and continues to be in terms of navigating the financial markets. Technical analysis is 100% of what we do and what we look at. Not to say that we think fundamentals are garbage. That's not the case at all. Fundamentals are absolutely very, very important. But the technical side of the equation answers a very, very different question. It answers a different question than fundamentals. Fundamentals are going to tell you what companies you want to own. Technicals are going to tell you when you want to own the stocks of those companies. And so that's how we look at the world of technical analysis. So no, to answer your question, I didn't necessarily have a lean towards technical, towards fundamental, and frankly didn't have an exact understanding of where in the business I wanted to go. I started studying finance because it was something I was interested in, something I was passionate about. And I thought maybe, if nothing else, it will become useful. The knowledge I gain will become useful to me, in my personal life down the road. And the more I got into it, the more I developed a true passion for the business.
I love it. It's a really good story. And that's kind of why I was asking, because I know most people come on the show are very heavy fundamental driven, but I know you guys are more technical driven. So I was just curious in your own journey early on, not as a kid, obviously, but as you were getting older and more interested into finance and understanding of the dynamics, if you had a leaning in any one direction. But I had the same journey on my end where it was mostly fundamentals and all of a sudden technicals, and then boom, and I went a step further and came up with this concept called psychological analysis for markets, and I have a book coming out on the topic. But I'm a big fan of technicals as well, so that's good to know. So if you can, Jay, just let us know a little about your investment strategy. I mean, technicals are obviously, it's a very big lean. How do you guys play the game, and what separates you a little bit from the pack, and so on and so forth?
Yeah, you're absolutely right. And, technical analysis is a big term. There's lots of items that fall underneath the technical analysis. And, really where we live is in a lane and a specific methodology of point and figure technical analysis. So, point and figure is one method of technical analysis. There's lots of methods out there, and there's lots of different charting softwares out there. But, we look at point and figure specifically, and it's X's and O's. When you look at a chart that has X's and O's in it, that's a point and figure chart where X's simply represent the price of a stock is rising, and O's represent the price of a stock is falling. And over time, those patterns, those columns alternate back and forth. This is nothing that we developed. The methodology goes back many years, back to the late 1800s, and Charles Dow was really the first proponent of this form of technical analysis. Certainly having a very, very strong understanding of the fundamentals is important, but also understanding the price action and price movement of the securities is important as well. And so, for us, the point and figure methodology is a logical, organized way of uncovering the imbalances between supply and demand in the marketplace. And that is the key to everything that we do, understanding supply and demand. Supply and demand is around us in every aspect of our lives. And we know that if there's more buyers for a particular good than there are sellers, then the prices are going to rise. And if there's more sellers for a particular good than there are buyers, then prices have to fall. And if buying and selling pressure are equal, then prices have to remain the same. Well, the same forces that drive prices of produce in the supermarket, or the prices of cars, or the prices of baseball bats, or whatever it is that we're looking at, if there's more buyers for that good than there are sellers, then prices have to rise. Those same forces ultimately are what drive the price of stocks over time. Right. If there's more buyers for a particular stock than there are sellers, then the price is going to go up. And if there's more sellers than buyers, then prices are going to go down. And so, if we get to that point, and then just having a logical, organized way to identify that and to see that, that's what the point and figure method of technical analysis does for us. And that's what, we rely on in terms of our research platform. We track about 26,000 securities that trade on exchanges all over the world, not just in the US, but we track stocks that trade in Asia and Europe, all over the world. We're looking at markets. And it's because the reason we can do this, we can literally cover the world, is because it's based on price. It's a purely objective input. And so when we talk about investment strategy, our research platform is built off of this idea of point and figure methodology. From there, we also use relative strength or price momentum through the lens of point and figure to help drive various investment strategies, whether it's strategies that are used as indexes that are inside of exchange traded funds, whether it's strategies that get used to manage ETF model portfolios, or whether it's other strategies that we're looking at relative strength and price momentum on individual stock universes for traditional separately managed accounts. At the end of the day, the objective input that we're looking at to drive those strategies really is price at the end of the day.
Right. So let me ask you a question, because in technical analysis, a lot of people tend to use bar charts or candlestick charts, and they don't typically use other charts. I mean, there's lots of other ones, but I'd specifically just ask about patterns. So most technical analysts tend to look at patterns, like cup with handles, double bottoms, head and shoulders, so on and so forth. So how do you guys use patterns, and B, if not, why or why not? And then how do you incorporate pattern recognition into your technical analysis?
We do absolutely look at patterns, and there's double top, double bottom, all that kind of good stuff are certainly patterns that are utilized within the point and figure methodology. There's a number of patterns that exist within point and figure, and there's a handful of patterns that we look at. Some we look at triangle patterns, or there's other patterns that we look at as shakeout patterns, and both on the bullish as well as the bearish side. When we look at some of these patterns, one of the benefits of the point and figure methodology is the very much objective nature of those patterns as they develop. There's no subjective pattern development, or if something breaks what we would call a bullish triangle, there's a very specific set of rules that it has to meet in order to fit that criteria. And so if you were to call into our office in Richmond, Virginia, and talk to any one of the analysts on our team, you're going to get the same answer from one to the next in terms of the pattern that particular stock might have developed or is developing. And so, I guess the reason we kind of gravitated over the years, and really, when I say we, Tom Dorsey and Watson Wright, who started the firm, is just the objective nature and the simplistic nature of point and figure in terms of identifying those particular patterns that are out there. So yes, patterns, especially in the individual stock evaluation, are very, very important. As well as if we look at all the stocks in our system right now, every single one of those stocks is either going to be on a buy signal or it's going to be on a sell signal. There's no in between when it comes to a point and figure chart. Something's either on a buy signal being controlled by demand, or it's on a sell signal being controlled by supply.
Well, that was my next question, so thank you for answering. I was really just about to ask that. So what about volume? Do you guys incorporate volume? I know most technicians do into your analysis.
Volume does not come into play when we're looking at it. It's based purely on, when we're looking at individual stocks in terms of the point and figure methodology. Volume is not something that is taken into account, nor is time. I mean, time is not taken into account either. More, it's about the price movement of individual stocks, of ETFs. We track ETFs of mutual funds. We chart, over 16,000 mutual funds, as well as ETFs that trade all over the world too. And so it's all done through that lens of point and figure.
Got it. And then what about breakouts and things of that nature with your technical analysis? Do you guys, as far as entry points, the technicals tell you when, like you mentioned, do you guys buy traditionally with breakouts, or do you guys look at other ways, more advanced ways of entering and exiting? support, resistance, so on and so forth?
Yeah, so certainly, we talk about in our research reports, buying stocks on breakouts, but also buying stocks on pullbacks, and so, all of the kind of traditional looking at areas of support, looking at areas of resistance, are all very, very important in terms of our evaluation and understanding of individual stocks. Whether it's looking to exit a position or looking to enter a position, all of those things are certainly important. I will say, in terms of some of our investment strategies, so some of the model portfolios that we run, whether some of the ETF models or individual stock models, they are those strategies, those model portfolios are very much systematic and rules based. And so there's a very specific set of rules that governs how a stock might go into a model or how a stock might come out of that model. And in some cases that might be if a stock falls below a certain technical attribute threshold. So within our system, we apply a technical attribute rating for every individual stock that ranges from 0 up to 5 being the strongest. And those technical attributes are based on, number one, the overall trend of that stock on its point and figure chart. So if it's trading above the positive trend line, which is known as the bullish support line on a point and figure chart, then that would be one positive attribute. If it's in a negative trend, then that would not count as a positive attribute. The other 4 of the 5 are relative strength driven. So short and long-term relative strength versus the broader equity market, and then short and long-term relative strength versus its peer group or its industry group. And so of those 5 attributes, what we look at there is wanting to see a majority of those positive to be investment grade. What we want to do is we want to, stack as many chips in our favor as possible to tilt the weight of the evidence positive. And so we look at those attributes as anything that's 3 or better would be investment grade, 5 being the best out there. And then anything below 3 is something that we would consider to be below investment grade, more speculative, not something that a long-term investor would want to be owning over long periods of time. So in terms of that, the technical attributes within our research platform is very, very important. And we've got some, done a lot of research and testing and some, published some research pieces around the benefits of incorporating technical analysis technical attributes specifically into, portfolio management.
Got it. So what about from the systematic side? Is there a discretionary component to the system as well, or is it more just, hey, follow these rules and here are the results?
Yeah, so on the model portfolio side of things, there is no discretion that we take in terms of driving those models. We let the system run those portfolios, how the models and how the rules are set up. And so now we're obviously setting down, developing the models based on testing and studies. But once that happens, then the models are going to run based on the rules. There's no discretionary element that I'm, for instance, allowed to go in there and override a signal that might have come. If we get the signal, then that signal is going to be taken, because you know as well as I know, as soon as I try to get in there and manually override the signals, it's going to be the absolute wrong thing to do. So what we found over the years is having a systematic process. While no trade's going to work out perfectly every single time, but having a systematic process in place is what we have found ourselves to work much better over time.
Yeah, no, that makes perfect sense. So the next question I have for you, Jay, is how do you handle risk, and what mistakes do you see people make with respect to risk management?
Well, yeah, risk. I mean, risk is always out there, and it's not about completely eliminating it, because being overweighted within a certain area is risk, and being underweighted in a certain area could be seen as risk. There's certainly a risk in holding too much equity in a portfolio sometimes, and there's certainly risk in holding too much fixed income in a portfolio, just as an example. And so in terms of thinking about risk and constructing strategies there, it's not so much that we're laser focused on the amount of standard deviation or volatility per se within there. What we have seen within our strategies is we have typically, like, momentum or relative strength really is the investment process or the factor that drives our returns and really drives the portfolio decisions over time. And what we have found is we want to buy the strongest areas of the market and avoid the weakest or the weakest relative strength areas of the market. Because over time, what we have found, and very similar to studies in our research papers and those types of things, is the big excess return within the markets typically comes from the higher relative strength or higher momentum names. And there's not just us, there's lots of research out there that talks about momentum as a factor in driving excess returns over time. But what we've found interesting over the years through some of these studies is that the higher quote unquote risk or higher volatility names in the market are often the ones that have the weakest relative strength. Those are the areas that over time have generated the more volatility, more standard deviation, more price fluctuation in the marketplace than the higher relative strength stuff. So what we do with our investment strategies is really focus and concentrate on buying and staying invested in the strong stuff, but also having a sell discipline. And so the sell discipline for us is also is key, and another way that we try to help mitigate some of that risk. If something falls out of a certain rating or certain ranking within our relative strength matrix thresholds, then those things will get removed from the portfolio and replaced with higher ranking things in there.
So by lower relative strength, you mean stocks making 52-week lows or trading the bottom quartile of just in general, like weakness instead of strength?
Yeah, in general, weakness, when we compare, when we talk about relative strength, or I mentioned the concept of a relative strength matrix, that idea is comparing each stock versus each other in a big relative strength comparison. So if I were to have, let's just say for an example, we could run a relative strength matrix on, let's say, the Nasdaq 100. In order to do that, that would take almost 10,000 relative strength charts to compare each stock versus every other stock in there. So it's almost 10,000 relative strength charts that are running. Each one of those relative strength charts, if we compare stock A to stock B, then it's going to be on either a buy or a sell signal on a relative strength chart. And once we go through that comparison of comparing every stock versus each other out there, then we will simply rank those based on the number of relative strength buy signals or quote unquote wins that each of those stock has versus every other. So I could take a universe of 100 stocks and rank them strongest to weakest based on those relative strength, based on the number of relative strength buy signals that each of those stocks has. So when we talk about buying the stuff that has the best relative strength, basically what we want to be buying the stuff that has the higher price momentum, or the stocks that are performing the best relative to the group that we're looking at there.
Understood. So you're looking at leadership is basically what it comes down to. You want to find leading stocks. Yeah, understood. So, okay, so risk, as far as entry to exits, percent risk, overall portfolio, how many stocks in a portfolio do you enter and then say, I'm going to exit if it falls by 10% or 8% or 6%, or do you guys use that as a actual hard level of, hey, here's my risk management? Or is it more along the lines of an asset allocation strategy where it's like, hey, if we just own leading stocks and let go of everything else, we'll do fine?
So within our strategies, and it's going to vary strategy in terms of the number of holdings, but typically we're not going to have a hard stop of if the stock falls by 10%, it's going to get kicked out of the portfolio. But it's going to be if it falls to X% rank, then it's going to get kicked out of the portfolio. For an example, we might look to buy stocks that are, it has to be within like the top 25% of our relative strength rankings. And if it falls, if a stock falls below the 50% mark, so if it falls out of the top half of its ranking, then it's going to get kicked out of the portfolio and sold at that point. So in terms of hard stops, it's more the hard stop on the ranking and where it falls relatively within that ranking. But that, you know, that idea of, and those numbers can get tightened up for more concentrated portfolios, but typically, you know, the thought process of, you know, typically within a universe, and if you're, you know, building out a universe of individual stocks, of ETFs or whatever it might be, those are pretty good rules of thumb that we found. And you know, buying things that are in the top 25% and holding them so long as they stay within the top half or within the, you know, outperforming a majority of the universe, those are pretty good starting points to look at.
And then do you guys change your strategy in bear markets, or is it still, if it's based on relative strength and the market's going down as well, but a stock goes down? So if you have the market go down 20%, the stock goes down 10, technically it still has strong relative strength, but the stock's down significantly. Does that impact the decision-making process, or is it based on just an overall weighting based on irrespective of what the market's doing?
Yeah, so we can compare, we can do relative strength comparisons against things like cash. And, you know, we compare, you know, equities to a cash proxy all the time. So to kind of understand, is cash doing better than equities or vice versa? And so those decisions, we can certainly run those relative strength comparisons. And there are some of our strategies, some investment strategies that we run that have the ability to get defensive and you know, raise cash in bear market types of environments. Because absolutely, to your point, within a, you know, just relative strength ranking of all equities, if everything is falling, you know, the best relative strength stuff is just going to be the stuff that's down the least. And, you know, but it's still down. So there are a number of strategies that we run, both on kind of the managed account side, as well as some strategies that inside of indexes that have the ability to raise cash inside of those. And basically, if cash gets up the rankings, then cash can come into the equation. As a matter of fact, within one of the tools within our research platform is a tool that we call DALI. It stands for Dynamic Asset Level Investing. And that at a very high level looks at 6 broad asset classes and ranks those on a relative strength basis. And those asset classes consist of US equities, of international equities, of commodities, of fixed income, foreign currency, and cash. Those are the 6 asset classes that we look at and that we rank based on the relative strength ranking. So, you know, cash is certainly something that we look at as an asset class, as an asset class that, you know, can be invested in, and you know, in some markets, it's, you know, certainly an asset class that can be very beneficial.
Interesting. So the relative strength isn't only based on the S&P 500 or some other benchmark; it's based on all of those things you just mentioned.
Right. Exactly.
Do you look at stocks in sectors and compare how your stock or industry groups and say, hey, this is I don't know, a gold stock and other gold stocks are acting well, this one's lagging, therefore it has poor relative strength? Or is it just that stock based on the how that stock is acting based on the market and all those other things you just mentioned?
Well, yeah, when it comes down to looking at individual stocks, we absolutely look at how it's doing relative to the market. But part of that technical attribute reading that I mentioned earlier, 2 out of the 5 attributes is peer comparison. So how is a stock doing relative to an equated basket of its peers? And so yes, to answer your question, we can compare any stock to an index that it would fit into. And then we can also take that a step further through the relative strength matrix concept. And one of the things that we do on our site too is we rank each stock within all these sectors. So we could say if I like technology, or I like semiconductors, or whatever it might be, go in and say, okay, out of the semiconductors, what's the strongest stock within the semiconductor sector? Or if I own a semi stock, where does my stock rank within all the others out there? Should I be looking at other options instead of the one that I currently own?
Got it. And then that's risk on the downside. The other side of risk that I like to talk about, specifically people like you that are technical based, is risk on the upside, chasing. So in other words, most technical analysis tells you, hey, there's a pivot point or some kind of entry point. You buy the breakout and buy within, I don't know, 4 or 5% above the breakout point, if not at the breakout point. Do you guys incorporate chasing as far? You spoke about momentum and you speak about relative strength. So I'm assuming we're looking at leading stocks as well. And there tends to be a lot of that when do I enter component. How does a technical analysis handle, I guess, that side of the equation?
Yeah, so I mean, with technical analysis, whether you're talking about a stock that gives a buy signal, or whether you're buying high momentum stuff, just by definition and by nature, there has to be some period of either absolute performance or relative performance before we're going to buy. And that's just by definition and by nature. In order for something to move up in the relative strength ranking, then it has to, by definition, outperform the other things that we're looking at there. Therefore, you're buying something that has already outperformed. So the big question and the mental roadblock a lot of times is, well, if it's already outperformed, I'm too late to the game, right?
Right.
But like the law of motion, things in motion tend to stay in motion until acted on by an opposite force, right? That's the whole idea and the whole concept of relative strength or momentum. Those things that have done well have shown a propensity to continue to do well into the future. And so, that is just, kind of the definition and the nature of momentum and relative strength investing. And very similarly, on individual stock, kind of traditional technical analysis side of things, is we're not going to, buy stocks that are falling. And it's very almost complete opposite to more value investing, where, the more a stock falls, oftentimes the better value becomes, which is, very, very different thought process and investment strategy over time.
Got it. So yeah, that makes good sense. And you mentioned earlier not buying blindly off a 52-week high. You guys wait for pullbacks. So that's, I guess, another component of it. So
there's actually a report on our site that we run that is called a buy on pullback report. And every day, these are stocks that have broken out, showing good technicals, but have pulled back close to their bullish support line or close to a level of support for buying. Yeah.
Love it. And then next question for you, Jay, is how do you, or I guess, what are some timeless lessons you've learned along the way that you can share with the audience?
Yeah. I mean, I think some of the things that we've learned, I would say, as a firm over the years is, having an investment strategy and remaining disciplined to its implementation. And that, certainly sounds, pretty simple, but time and time again, when things start to change, and if you have a process, and if you're a value investor, then understand it, understand when it works, understand when it's not going to work, understand why it works. If you're technical, if you're momentum, I would say understanding the process is so important, because it can help put everything into perspective. And there's going to be times when relative strength or momentum strategies don't work as well. There's going to be times when value strategies don't work as well. And so, what becomes really hard is trying to jump and bounce around between all of those different ones. There's benefits in combining them together inside of portfolios. But so for us is, having a process, having a discipline, and sticking to that process and executing the game plan in the market, especially when volatility and uncertainty comes into the equation. Is having that process, having that game plan can certainly help make some of those investment decisions, whether it's a buy or sell signals, help make them much easier. And
I
so,
love it.
like I said, I think just the discipline for it is really what's key for us.
Yeah, to avoid style drift, right? They call that style drift when you drift from style to style and keep drifting.
Yeah, remaining true to what you are. And it's not to say, I mean, we are continually, testing and looking to improve upon what we're doing. But it's, but that's something that I think you should always be doing is, how can we continue to improve, the strategies that are out there, or bring new strategies out, or new ideas. And that's, certainly part of the game. And part of the discipline that comes with it, though. But sticking to that game plan and to your point of the drift is, remaining true to that.
Yeah, no, that makes perfect sense. And then what are some timeless mistakes you see people make besides style drift, and how do you avoid them?
Well, in terms of mistakes, I mean, I won't pull out my whole trade history, because there's been plenty of things that haven't worked out in there over the years. But like I said, like I said, just in terms of the quote unquote mistakes, if you will, or things. It's a lot of times, and a lot of the areas that that we've seen is not being disciplined and true to the strategy, where that concept of manually overriding the signals that were given and not taking those signals. Those it's those points in times that often provide I guess disappointments, if you will, inside of portfolios, where the signal comes and then you kind of put your manual override onto it, and then it goes the other way, and then you're stuck chasing it, and then so that whole concept, and we've probably all been there a time or two, and so trying to avoid those things, especially on in the discretionary side of the world, is extremely important, and just the being disciplined side of it.
Got it. No, makes perfect sense. And then I guess the final question I have is, what's the best piece of advice you can share with the audience on or off Wall Street?
Yeah, I kind of went through a little bit of a story, in terms of on or off, finding something that you're truly passionate about, whether it's in the financial markets or not, is ultimately, what I think, brings success as well as happiness, and that's, if we kind of focus it specifically on the markets, and investing, that really came to us and to me through technical analysis. That was something that once I got into it and understood it and developed a passion for it, and overly probably, but nonetheless, dug into books and content, and so just getting educated about the methodology and understanding when it works, understanding when it doesn't work, and trying to learn as much as I could about that, and not stopping there, but continually seeking out education. And a big part of what we do at Dorsey Wright is educate right. Through webinars, educate it through, well, we used to in-person events, and maybe someday again we'll be able to do that. Educate through, but using technology to get education out there, but also to gain some of the education. So, education is a big piece of what we do, and we've gone into over the years, gone into universities, and even many years ago, Tom and Tammy, who I mentioned earlier, actually went in and taught at a local elementary school here in Richmond, Virginia, nice. And taught the point and figure methodology to students there, and so. The education side of it is certainly something that is very, very near and dear to our hearts, and something that is going to continue to be important for our business going forward.
Yeah, I love it. I'm a big, huge fan of education as well, underline huge, and I can't get enough of it. So I really want to thank you very much for coming on the show. Before you go, Jay, what's the best way for people to get in touch with you?
Adam, it's been a pleasure. I appreciate being on the show. And so in terms of just getting in touch, there's a number of ways. If you want to go to our website, it's just dorseywright.com, DORSEYWRIGHT.com. There's some information out there. If you are interested, you can click a link on that page to sign up for a free trial, or go to dorseywright.com/trial. You can also email directly dwa@dorseywright.com. My email is jay.gragnani@dorseywright.com. That's GRAGNANI. And then our phone number is 804-320-8511. So Adam, I really appreciate it. Great talking with you.
Likewise. Thank you so much, Jay, for coming on the show, and hopefully we'll speak again soon.
Sounds great. Thank you.